Annual price rises slowed in April, according to inflation figures, but a carefully monitored monthly price index continues to grow at an uncomfortably brisk pace. The latest statistics revealed that the factors that have kept inflation high for months are still strong, posing a challenge for both consumers attempting to keep up with growing costs and the White House and Federal Reserve as they strive to get the economy back on track. In April, annual inflation slowed for the first time in months, but the Consumer Price Index still rose at an uncomfortably fast rate of 8.3%. Simultaneously, a frequently studied metric that excludes food and gasoline expenditures surged. Core inflation, which includes food and energy expenses, increased by 0.6% in April from the previous month, above the 0.3% rise in March. This figure is very significant for policymakers who use it as a guide to predict where inflation is heading. How does this affect the stock market? In this video, we will attempt to answer that question, so stay with us till the end because our last point is something you may not have considered. Inflation causes the stock market to become volatile. Although we don't want to panic in the face of inflation, we need to recognize its consequences. A rapid increase in inflation, as we've seen in recent months, might cause market instability. Stock prices and market returns are heavily influenced by estimates of companies' future profits. Because inflation reduces the purchasing power of a dollar of profits, it may be difficult for the market to determine the current worth of the companies that comprise market indexes. Furthermore, rising material, inventory, and labor costs might have an influence on profitability as businesses react. As a consequence, stock values might vary, resulting in volatility. When we encounter high volatility, notably negative market returns early in retirement, it might have an influence on the potential lifetime of our retirement portfolios. This is also known as a sequence of returns risk. High inflation may be expensive to consumers, equities, and the economy. Value stocks outperform during times of high inflation, whereas growth stocks outperform during periods of low inflation. When inflation is high, stocks tend to be more volatile. What is the definition of a value stock? Value investors are drawn to value stocks because they seem to trade at a lower price than their fundamentals, such as dividends, profits, or sales. A value stock is one that trades for a lower price than the company's performance suggests. Because the price of the underlying shares may not accurately reflect the company's performance, value stock investors seek to profit from market inefficiencies. A high dividend yield, a low price-to-book ratio, and a low price-to-earnings ratio characterize value stocks. Using the dogs of the Dow investment technique, investors may identify inexpensive companies by acquiring the Dow Jones 10 highest dividend-yielding shares at the start of each year and modifying the portfolio every year after that. Banks are an excellent illustration of value stocks. What is the definition of a growth stock? A growth stock is any stock in a firm that is expected to expand at a pace that is much higher than the market average. The majority of these stocks do not pay dividends. This is because growth stock issuers are often businesses that seek to reinvest any profits in order to increase expansion in the near term. When investors buy growth companies, they expect to profit from capital gains when they sell their shares in the future. Amazon has been regarded as a growth company for a long time. It is, and has been for some time, one of the world's biggest enterprises. Amazon is the fourth most valuable stock in the U.S. as of September 24, 2021. What is inflation? Inflation is defined as a rise in the price of the goods and services we use, which reduces customers' purchasing power and limits what they can buy with each currency unit. Let's look at how inflation affects the stock market and how we could position ourselves as investors during periods of high inflation. Inflation is defined as the progressive rise in the price of goods and services. This in turn reduces the purchasing value of money. This is what people mean when they say a currency loses value over time as opposed to the in-currency markets. Buying anything now, for example, is more costly than buying it yesterday. This is why your granny may give you $5 and tell you not to buy everything at the corner shop you might have really been able to in her day. How does inflation affect the stock market? Rising inflation is often bad for the stock market. Let us try to explain why this happens in non-monetary terms. This phenomenon is produced by a variety of factors, all of which contribute to the stock market's decline. Inflation will have a higher effect for corporations in growth, which are expected to generate more profits in the future. This is because any expected future profit would be diluted, owing to the impact of inflation on the value of money. When there is a lot of inflation, getting money now is better than getting money later. In 10 years, if inflation is 2%, future profits will have a low discount rate. Future gains, however, will be discounted at a larger rate if inflation is 10% or higher. Amazon is an example of a rising market share that made a loss while gaining market share. High-yielding stocks are more sensitive to increased interest rates. Shares that concentrate on low growth and high yield, like electrical utilities, may be sensitive to increasing interest rates because if rates rise, investors may exit these sorts of shares and migrate into government bonds and savings accounts, which now provide similar superior yields. It all depends on the kind of inflation in question. Companies are more likely to benefit if inflation develops gradually as a consequence of strong economic growth, and the negative impact of inflation may be reduced by higher growth and confidence. However, if inflation is caused by a cost push, goods will most likely become more expensive, resulting in stagflation. Will your stock investments be affected by the Ukraine war? Russia's supply of oil and natural gas to global markets is expected to remain uncertain for the foreseeable future. As a consequence of restricted supply, oil prices have already risen to levels not seen since 2008. Higher global oil prices will almost certainly have an impact on our economy, increasing pain at the pump and increasing expenses for companies and the items they create. Furthermore, since Russia and Ukraine account for almost a third of world wheat exports, grocery prices, which have already been high for the last year, are likely to rise much more. While European tensions may cause short-term inflation and volatility, they should not cause you to abandon your long-term investing approach. Investors should also keep in mind that protracted bouts of inflation are common in the U.S. What does the rate of inflation mean? The rate of inflation measures how quickly prices grow. The Consumer Price Index, or CPI, and the Retail Pricing Index, or RPI, are the two key inflation indicators. Each index is a basket of goods and services, allowing us to follow price changes across a broad range of things. Meatless sausages, sports bras, and antibacterial surface wipes were popular enough to make it into the basket in 2022. They replaced less popular items such as donuts, men's clothing, and coal. As a result, we have a pretty representative sample of what we buy and how typical expenses vary from year to year. What causes inflation? A lot of variables may cause inflation. Cost-push inflation happens when the price of raw materials or production increases, prompting businesses to boost their pricing. When the price of oil, for example, rises, it produces a ripple effect that impacts a wide range of enterprises. If clients are willing to pay more, a rise in demand is followed by an increase in pricing. This is referred to as a demand-pull inflation. This was evident during the current semiconductor shortage. Car makers were unable to satisfy demand for new automobiles, but buyers were so desperate for gas-guzzling vehicles that the price of used vehicles surged. Wage-push inflation happens when increasing wages force businesses to incur higher costs, which are then passed on to you. Due to labor shortages and increased demand for certain skills, more compensation may be required to retain current workers or attract new ones. The government's fiscal policies may encourage you or your company to spend more money. To stimulate the economy, the government may consider decreasing taxes or investing in large-scale infrastructure projects. Lower interest rates may arise from the monetary policy. This is a move that increases your discretionary income while decreasing your need to save. It also makes it possible for companies and institutions to borrow money at a lesser rate. When it comes to inflation, it's a case of chicken or the egg. Multiple elements often interact, making it difficult to discern what happened before and what is influencing what. Is inflation useful or detrimental? Both are true at the same time. Maintaining a healthy level of inflation is a tricky balancing act. This is because some inflation is required in a healthy economy. Allowing it to spin out of control might have a number of severe repercussions. A Goldilocks economy refers to attaining the proper balance. This occurs when there is sufficient growth to avert a recession, but not so much that inflation becomes unmanageable. It's the ideal temperature, neither too hot nor too cold. Keeping the economy in proper balance is obviously more complex than reheating a cup of oatmeal, but you get the idea. Don't worry too much. Long periods of inflation in the U.S. are unusual. For the last 10 years, there has been only one occasion of inflation reaching 5%, and that was from 1973 to 82. Despite the fact that it was a particularly difficult moment in U.S. economic history, there have been only 7 occurrences in U.S. history with consecutive years of 5% inflation, and 2 of those were in the 1800s. Long periods of inflation are possible but not common. What do you think will happen in the stock market given this new rise in inflation? What else would you like us to talk about in our upcoming videos? Let us know in the comments below, and make sure to subscribe and turn on notifications so you don't miss out on any of our videos.